Welcome everyone once again on MINTIT channel. Today we are having Mr. Nitin Arora with us, who is handling Axis Multicap, Midcap, Value Fund and India Manufacturing Fund. He is managing almost 40,000 crores. So without wasting time, let's start with the questions. Hi sir.
Hi.
So while starting, can you please share your complete journey, how you came to this field and what is your experience as of now?
So I'll give you a little perspective. It's been an amazing journey because I've been into markets for almost like 18 years plus now. Started my career as a sell side analyst, then moved up to the buy side, becoming an analyst on the buy side, mutual fund, and then becoming a fund manager. I think there's a lot of experience what you gain from the ground level, doing research first on the different companies or different sectors, and then move up the chain towards handling money. And that's been a different role I've been into it, and that gives you a lot of experience of how has been different sectors are doing, what changes the country is going through. Because remember one thing, country has gone through a lot of changes globally, trends are changing, country is changing. So I think it's very important to get evolved with that change. I would rather also say the way fund management used to happen about 10 years back has changed a lot because markets have evolved. A lot of companies have come for the IPO, a lot of new age businesses have come for the IPO. So it's been a very interesting journey.
Great, great. So, what I wanted to ask you about is our economy. What is your assessment of the Indian economy, demographic trends, and future growth potential? And which key factors and drivers do you believe will support its economic expansion?
So I think we've been maintaining since long at Axis Mutual Fund that our country, and when you look at the today's demographic or today's GDP, we are the best at this point in time amongst the global economy, right? We are the fastest growing economy at this point in time. The question today is that people are looking, having a very short term view because there has been a little bit slowdown the country is facing at this point in time. But I think the government is doing its job by increasing the capital expenditure a lot. We have seen maximum amount of capital expenditure happening towards the transmission distribution cycle, the renewables, the EMS companies, the electronic manufacturing is going really big in India. And now when you look at companies like Apple, who's investing so much in India, and that's happening for real because we go and see the plant as well. So I think the economy is now what we believe will grow much faster at this point in time. There will be hiccups because consumption is one where the government and even we are worried about that why consumption is not going up. Whether you look at the auto sales number or whether you look at the FMCG numbers or even the premium discretionary. And that's what I think the government realized. And we've been saying very openly to in all the forum that government has this realization. They need to do something on the tax side, and I think that's what they provided. And by giving a GST cut, and I think that's a very decent boost what they are giving to the end market, to the end consumer. The open and the important thing you need to look is now the rate cut cycle has also started to begin. What we have seen, it takes time. It takes about 6 to 12 months time frame before the consumption starts coming in. But our view is that once it starts coming in, then it'll be like very fast. So we are very positive, and we are taking a very bottom up approach across the portfolio. So we are very positive on both capex and certain pockets of consumption, not the staple side, but we are very positive on the premium discretionary.
So, what do you think? What factors have prevented India keeping pace from other emerging economies from last 25 to 30 years?
Sure. I think what the missing piece was the capital expenditure. Okay. If you want to become an economy which has to be self-reliant, if you want to create your domestic market in a big way, you need to spend money on the capital expenditure. And I think that's what the government realized in 2020, just at the time of the COVID. And that's where when you look at the manufacturing capex as a percentage of GDP, that shot up from 6% to about 14-15%, right? And we believe there is a more headroom to it. If you look at the example of China, right? China was never a consumption market, right? They started their economy with manufacturing. And whom they learned from? They learned from Taiwan, Japan, and everything, right? And they got into a scale game. When you look at today, India at this point in time, they're doing exactly the same, getting back scale where there is an easy way out. Government giving a lot of subsidies to the corporates to invest. And that's what we are seeing, the supply chain is getting created. We are the large, almost like the third largest renewable capacity addition country, and the appetite is still not stopping. They want to make even the renewables sell over here. So I think it just takes time. And I think this catch up is starting now. We believe that capital expenditure is where we don't see too much dent happening because of whatever the government is giving a booster to the investor, to the end consumer by way of GST cut. We believe that government, if starts ramping up more capex, I think we'll catch up with scale with a lot of economies now. And that's been an example that a lot of business we see shifting from Europe to India amongst even auto ancillaries because the cost is not viable at this point in time. So we are seeing those green shoots coming into the country and we are very positive on that.
Okay. As a fund manager, how do you interpret the current state of corporate balance sheets in India? And how would you categorize or segment them for a clearer understanding?
So I think when you look at the corporate balance sheet, right, it's really good because the leverage on any balance sheet, being the large cap, mid cap, and even smaller companies, the leverage is hardly anything. I mean, maximum what we see is 1 time to debt to EBITDA. That's also in a smaller cap companies. I think what promoters have also realized that leverage is something, is not a right option to keep it in the balance sheet for long because cycles can come and go, right? And that's been the learning for a lot of corporates in the country. So it goes bad for the banks because you don't lend to the corporate. You have stock market which is very buoyant at this point in time, and people want to invest in such companies, and we're getting a lot of flows out of it, the industry as such. So I think that's been one of the trigger and reason why the multiples of Indian markets or Indian companies are not falling, because despite being the cycle lower, or let's say the cycle goes bad, your balance sheets are so good at this point in time, and there is no pressure on the promoter to take extra leverage and all, and which is keeping the valuation a little higher. So I think that's giving an edge to the country, and that's why they're spending a lot. The capital expenditure is quite high by a lot of companies.
Generally, we see balance sheets into three parts like government balance sheet, corporate balance sheet, and retail balance sheet. What is your call on this?
So I think as we discussed, I think the corporate balance sheet is pretty strong. Government balance sheet so far, when you look at fiscal, they are very much under control. We recently got a rating upgrade by the rating agencies for the country. And government is very fixated on that fiscal number. And everyone had a view 6 months back, government will not do anything. They are too fixated on fiscal. And look at the way they manage. They really give a cut to the consumer at this point in time. So I think barring the concern, what we just looking at the rupee depreciation, I don't think the government balance sheet is under threat. The gold reserves and everything is pretty much higher at this point in time. So I think when you look at government balance sheet or corporate balance sheet, is pretty strong at this point in time. What we are looking that this capex should lead to growth, and that's what everyone is eyeing for.
Some themes that were sleeping in the past, like PSU, defense, right, infra, have delivered phenomenal returns in last 2-3 years, and have lately been the favorite amongst the new investors. How do you read this, and what is your advice going ahead?
I think the market used to be very thematic 2-3 years back, okay? And there used to be one theme and everything used to go higher. In our view, I think the market from thematic has become bottom up, but not narrowed down, okay? And that is the reason what we are seeing, new companies are coming for IPOs, new papers are coming. These are very good companies. We've got very good new IPOs coming into the market. The business is very rock solid and can expand a lot. The important thing to look is that when you look at the capital expenditure, where it's happening in defense, it's happening in renewables, it's happening in across the supply chain of EMS. So, and that is the reason these sectors are not falling beyond a point, because growth is there in these sectors. The growth is not across the staple companies, right? You look at the companies, how they reacted even after the GST cut, the FMCG, right? The stocks are down from that cut price, because we understand that those consumption will take its own time. But given the premium discretionary, because, and it's not India, I mean, globally rich are becoming richer, right? And people know that there is a premium pricing or no pricing pressure for the companies selling a good product at a good price, right? And that's why when you look at the SUV sales, they were like 30% 3 years back. And before that, it was 10%. Today, it's 60%. And that market is still growing at 10%. So I think the important way to look at is, rather than not going into the themes, we believe that portfolio should be very, very bottom up. You have to be very clear where there is earnings growth. Multiples will get a little re-rated there, and having more disbelief stories in the portfolio. For example, TND has been a very, very big disbelief story for the market, right? And we believe that money can be made in the portfolio where there is a lot of disbelief in the market, because that's leading to earning upgrade.
Let's become a little bit specific about a sector, sir. What is your take on defense sector valuation right now?
Sure.
We have seen a very upside movement into it, but somewhere valuations, I guess, are pretty high, right?
No, they are punchy, and that's the reason I said the defense was one of the sector that was under the disbelief by a lot of investors. They thought that defense is something which will just grow about 12-13% and will fall. in terms of earnings growth. Look at the defense companies' earnings. I mean, especially the large cap ones. They are growing at 20% every year, right? They used to trade at 20p, 25p. They're trading at almost like 40, 45p. Now you have to look at valuation in context of a company growing at 20%, being cyclical and trading at 40p versus a staple company growing at 2% or even 1%, trading at 45p. And it's been a long history. Those companies are not growing. So I think market is in the context because the visibility on defense has increased a lot. These are not the companies or the order books are so strong that it will die down in the next 1 or 2 years. These order visibility are for the next 5-7 years. And that's the reason when I stated just 2 minutes back about the statement, the multiples are not getting derated. Every quarter these companies are delivering 15-20%. If you look out the earnings growth, it's still coming from the B2B space of the country. B2C is not delivering that much. In B2C, the companies which are able to gain market share is only growing. So I think you have to be, and that is the reason I'm saying you have to be very, very bottom up, that where there is earnings growth in B2B and where there is market share gain in B2C, you have to be there.
So, looking at last 1 year return of Nifty, it is almost flat. How will you define it? It is a price correction or it is a time correction? Because time correction is something which is painful. Price correction is at least okay, but time correction is little bit painful. So, how can you define
So
it?
I think last 1 year has been a lot of volatility. Okay, we started with so many wars, and we saw the tariff war coming in. Okay, nobody would have thought about it that Trump would come in and this kind of a tariff war will happen, right? And that created a lot of jitteriness towards the emerging market, because global money which was ready to come to India or even the emerging market went back to US and China, right? And their returns have been phenomenal in the last 6 to 8 months. And still, when you look at our rate cut cycle is happening, right? And generally I've seen FIs putting money in an emerging market when rate cut cycle begins, but they're still not putting it. And I think it's largely because of the rate cut. It's largely because of the tariff war which is happening. So my sense is that it's more of consolidation, it's more of uncertainty which has played out in the last 6 months specifically, which even got us to a flat return year on year wise. But my sense is that if this tariff war sideways in the next 3-4 months, India is very, very well positioned in terms of growing very fast. Okay, and that is one of the reason that still you see appetite for new papers coming in. Okay, for new IPOs is still there, the scalability is still there. So I think it's just a matter of time in our view that if certain companies start delivering numbers, and that's the reason I'm always saying you have to be very bottom up in your portfolio. Where there is earnings growth is not everywhere the way it used to be 3 years back, very thematic, and earnings growth was coming. So I think my sense is that if you're in the right stocks, if you're in the right earnings growth portfolio, I think you'll be able to make money for the investors over the next 2 years.
Great. Considering the strong rally in value stocks over past 3-4 years and recognizing it as in value is a cyclical part, while growth stocks have historically driven superior long-term wealth creation globally, what approach do you typically adopt in your portfolio to navigate these dynamics?
So I think we never went into a debate of value and growth. Okay, I specifically being handling value fund, I never went into that debate. And I'll tell you the reason. The reason was very simple, is the multiple re-rating happens because of the earnings growth. I would not like to name companies here, but I'll give you a perspective that utility sector was one where the multiples were very low. But energy transition came and the sector got re-rated, right? And eventually the energy transition led to earnings growth. And that's the reason the multiple got re-rated. Otherwise, those multiples never went up. For example, in defense, right? The valuation went up because there is visibility of earnings growth that came in, right? In autos, we saw Indian OEMs doing way better than the European OEM, and market share got increased, multiple got re-rated. So again, I think as a fund manager, my job is to find that where is the disbelief, where can there be a surprises in earnings growth that will automatically lead to multiple re-rating. So rather than getting into a debate of value or growth, I generally run a portfolio on a very bottom-up approach, very earnings growth specific, and where I see the market share can happen, and market is in disbelief. So I think defense was where there is a disbelief. T&Ds, there's disbelief. Cell making companies in renewable, there's a disbelief in the market a lot. Autos, a lot of disbelief people had on the Indian OEMs. They have done fantastically well, right? Auto ancillaries, nobody would have thought those companies trading at 20p become 35p. And look at the earnings CAGR, it's 16-18%, right? Nobody would have thought that auto will slow and auto ancs will collapse. No, It's the premiumization that you need to look at it. That despite his largest customer not growing at 3%, more than 3%, these companies are still delivering 18-20% growth because of premiumization, because of the content increase. And I think these are some of the things which you need to catch rather than getting into a value and growth. I'll give you a simple example. There is no value in the market at this point in time. You just raised a point of valuation at this point in time. Is defense is a value? No, it's not a value, right? But is it compounding your earnings? Yes, it is, right? And we are still seeing there is more visibility on the ordering side, because in the current geopolitical issues, I don't think any government will take a chance of not spending in defense. It is not possible, right? Even if tariff war subsides, these are things which are now permanent into the economy of every country, because now China also wants to becoming a more consumption market. They already have a scale in manufacturing. Every country is looking what they can scale up to it, and that's the reason defense spending itself will increase. So I think rather than getting into a debate of value or growth, I take an approach of where there's a disbelief, earnings growth, which will lead to multiple re-rating.
How do you select stock sectors in the funds that you manage? Is there any framework, or it is
Sure.
completely on your conviction?
No, I think what we look is where is more tailwind. So we have divided our funds into three categories. One is investment, which is your B2B part. One is consumption, which is more premium discretionary we run. And one is net exports. So investment plus consumption plus net exports. Net exports is generally we take a call on the IT side. Okay. That's the framework we run. And in that framework we run, who has the ability to gain market share, especially in the consumption part. B2B, where we see that overall spends are coming down, but where there is a need to spend more. Like we took a very big call 3 years back across our funds that energy transition is for the next 10 years. And we still feel energy transition will remain relevant for the next 5 years. We will never we will not leave that theme. Defense is something we still believe has a lot of potential from here. EMS, because scale is just achieved by few companies in India, okay? And that is the reason multiples are higher. But these companies are delivering you 40-50% earnings growth, right? So I think these are certain framework, what we try to define, and then we look at how much cash they can generate. You'll be surprised to hear this, that the largest electronic manufacturer, mobile manufacturing company has never done a dilution in the last 5 years, and he's grown at 50%. People are worried about the valuation, but he's not done the dilution. The smaller companies who have done the dilution, right? So I think there's scale that happens, and we have learned these examples from China. Once that scale comes in, you don't need a dilution, they go very fast at this point in time. So I think we still believe there is a room for growth there. We still believe there is disbelief in the market. If you go right on your conviction, you'll make decent money for your investors. And that's how we've been able to generate returns over the last 3-4 years.
So coming, just extending this question, sector specific, what do you think, sir, what will be the impact of Gen AI on the IT sector?
So I think, see, there is a threat to it. We will not debate. And I'll give you a very interesting example. There are BPO companies who were under more threat, okay, under AI, because let's take an example of a customer sitting in London. He calls a UBS bank and you have a RM there. I remove that RM and I put a machine there, right? So that your audience can understand easily. Right. I'll give you a very simple example. Now that customer, when it calls that machine, okay, to put that machine and those commands, right, that cost you a very high number to the companies, okay? And company, let's say the UBS has asked any AI guy to put those machine to it, which has a very high cost, versus an RM, which has a certain automation on that machine, and plus an RM takes care of it, okay? The cost difference is 60-70%, okay? And that's exactly what we saw, that instead of these BPO numbers should have declined in the last 3 years, they have grown way better than the core IT sector. People transitioned, but people also reversed back, okay? It's still developing. We are not saying that AI is not a threat. We are seeing some replacement of personnel coming through that AI, but not that every job is something which is replaced by AI. That's the reason I gave you an example where it was easy to replace. If you need to call your credit card company today, you would have easily called by a machine, right? But it's still not happening because cost is too high at this point in time, and personal touch is what the customer needs. At this point in time. And we have seen those companies growing very fast. By the way, these are part of our portfolio, right? Another disbelief in the market. And that is the reason you need to be more, understanding where what's disruption is happening. But is it not the disruption? No, we are not saying that. We are saying this disruption is happening more on the large cap companies. Okay, because the size is pretty big. They're also thinking their growth is slower, so they are on a more fix at this point in time. So going forward, I think it's a very, very evolving technology. We are also learning from it because everyone, not us, I think look at US, look at UK, Europe, everyone is going through that transition along with us. So I think it's a learning phase. We have to be very careful where it really disrupts. But if you ask me a clear cut answer at this point in time, I think globally IT, the bigger companies have also not reached to any conclusion at this point in time. But I deliberately gave you that example where it would have hit the hardest. It has not done it.
So, what distinguishes Access Multi-Cap Fund from other multi-cap funds in the industry, and why might investor choose it over its peer comparison?
I think what we decide amongst our framework is to take very bottom up call. Okay, we are not saying that others don't do it, but there are certain sectors which I talked to you about. These are very well researched, and we then go all in, then we take it. We do that sizing part, because if I am going to be the same way the others are doing, the investors, that pullback in the returns or the pullback in the performance would have not been there. And number two, I think the kind of ROE, ROC, what we follow, despite, companies are going through their transition, going through different capex cycle. And that's the reason I gave you example of the largest mobile manufacturer, never did a dilution.
Right.
This is a part of the portfolio, not the PS portfolio. Okay. And people run the smaller EMS companies. We don't run it. The reason is because we believe their free cash flow and ROE, ROC will not be done. And that's the reason the valuation gap is huge and it's still expanding. So I think these are some of the areas where we try to take a little aggressive calls, and we do very well research on it. We have a very strong research team. I myself being, analyst, remained analyst for many sectors. I still do auto sector for the last 15 years. So I think these are some of the things which distinguish us from the other funds.
There has been a perception earlier that Axis Mutual Fund is a growth oriented mutual fund, and then they came with an Axis Value Fund. So, what was the rationale behind it? It is just an effort to line up with the category, or in future, Axis is looking to get into the blend kind of strategy for handling portfolios?
I think it's been a question that I've been answering over the last 5-7 years now. I think we never, as a fund manager, look the portfolio again in these two transitions. Okay. And as I said, as a fund manager, my job is to get my earnings right in that company where I'm investing. But given value has been a segment, because this segment got re-rated in 2019 post-COVID, because it started with US markets, went to Europe, and then came to India. But remember, this got re-rated because there is a reason of earnings growth coming up. Okay, I'll give you one more example. There are a lot of FMCG companies, or all values, right? We never buy it. Has been our performance bad? The answer is no. We never got into it, right? And it's been a long history now. The reason we don't get into it, because earnings growth are pretty weak there, right? So I think the way we look at, the way we run value here is more of taking a very high bets on the re-rating of the companies. The company which can grow market share, where there is more disbelief. This is the way we run the value fund. Okay, it's not very, very peculiar to the valuation of the company. And as I said, today utility companies are not cheaper as well. So if you look at in that context, you will not find any single company which is less than 20p in India. Very few examples you will get. Right? These are companies trading at, every company is trading at 30, 35p or 50p or 70p. So hardly there is value in the market. What you need to go right is what is the earning potential and scalability in the business. And we are focusing a lot on this aspect. And I think that is one of the reasons a lot of our funds got turned around in the last 2-3 years.
So can we expect the market turn around in second half of the year or first quarter of 2026?
So I'll not put a timeline, to be honest, because eventually it's a daily exercise, right? What we are seeing a transition. What we are looking at that we have pulled back very well in some of our large funds as well. And the focus is to keep identifying good ideas, good stories, and scale a lot. So we are very hopeful over the next 1-2 years, we should be doing very well over the next 2 years. And that's been the focus. And it's very, very, I would rather say that even if you go and check out the earnings growth of the portfolio, it's been very superior to the peers. And that is the reason the pullback is very strong now.
What do you see as a challenge for new fund managers in terms of managing returns expectation of investors?
I think investors need to be really patient. Okay. What is really happening is that the last 3 years run, barring the last year, if you look at the returns have been very good for the investor. And there are a lot of new age investors have come in the market, okay, who has not seen the previous down cycles, and what really becomes a challenge for a fund manager is to look at those newer ideas and how to assign those higher multiples to it. Okay, it takes time. And what is happening, market is rotating very fast. It's not giving you time to sit back and think about it for the next 10 years. Market is going too fast. Market is even sometimes capture the earnings of next 4 years in 1 year. We have seen that case as well, right? So I think what investors is need to look, and that is the reason we never deviated from the quality part of the funds. The reason is finally quality came back. It's a cycle at the end of the day. Okay, value has not done anything in the last 2 years if you look at the value stocks, right? So it's been a cycle. What you need to understand is how the companies are behaving in each cycle. For example, there are banks, right? We never go into the smaller size banks and look at this, the large cap banks who have performed well. Again, smaller banks didn't perform that well. Look at, just take out the Nifty BSE 150 index and just find out the bank's performance. You will not find a single bank giving you a return more than 10%. So I think this is something where the investors need to have patience. And last 1 year, that patience also, we saw that investors are getting jittery, no return for that. And this has been the cycle. There will be a time when the markets has got so fast re-rating, there will be a time of consolidation. And we always say to the investor, keep investing. Because if you would have not invested 10 years back, and now so much capex is happening, consumption is coming back, and if you don't invest right now, and I always say to my investors who I keep meeting, that whenever the NAV is down, that's the best day to invest, because you're not investing for 1 day or 1 month. You have to have a view for the next 2-3 years or 5 years, and that's where exactly money has been made. So I think investors, the challenge for a fund manager is that there are too many ideas in the market. I don't think ideas are not there. What you need to go is absolutely with the right company, with having a right scale over the next 5 years. You should not be sitting on the other side. That'll hurt the portfolio a lot. And for the investors, my only suggestion is that take a view of at least 3 to 4 years on the country. You will see a lot of tailwinds panning out over the next 3-4 years.
Great. With this, I will end up my questions, and this is a very insightful session, sir, with you.
Thank you very much.
So much. Thanks a lot, sir.
Thank you.
Thank you so much.
Thank you.